Becoming a Non-Resident of Canada, Part 3. Hi, my name is Allan Madan from Madan Chartered Accountant. Today, I'll reveal the last 5 out of 10 major tax implications of becoming a non-resident of Canada. For those considering leaving Canada to work, live, or retire abroad, this video is meant for you. This is the final part of a 3-part series. Inform your bank, financial advisor, and pension administrator. Upon becoming a non-resident of Canada, you should inform your bank, financial advisor, and pension administrator about your change in residency status. Your bank must begin withholding 25% tax from any interest that it pays to you. The same tax also applies for dividends paid to you. 25% of tax will be held from payments made to you from the Old Age Security, the Canada Pension Plan, and registered pension plans. As you can see, 25% is withheld from passive income paid to non-residents of Canada. The withholding tax can be reduced by a tax treaty that Canada has with your new country of residence. If a retired Canadian does not inform the CRA that they are a non-resident of Canada, they will continue to receive the gross amount of CPP and OAS payments without withholding tax being properly deducted. You will then have to repay the amounts received plus interest and penalties. Disclose all Canadian assets. When you become a non-resident of Canada, you must disclose all of the property that you own, totaling $25,000 or more, on Form T1161 on your final personal tax return. These are classified as reportable properties, and penalties of up to $2,500 can be levied by the CRA for non-disclosure. Tip: Canadian real estate, RRSPs, RESPs, and certain types of properties do not have to be disclosed on Form T1161, deemed disposition of property. When you become a non-resident, you are deemed to have disposed of all of your property at its fair market value. Any unrealized gains will be subject to income tax, even if you have not sold the property. This is known as departure tax, and it can add up to a significant amount. For instance, imagine selling all of the property you own and having to pay tax on the profits. This is actually what happens when you emigrate from Canada. Assets that are subject to departure tax include stocks of all public companies and private companies, mutual funds, exchange-traded funds, partnership interests, real estate situated outside of Canada, foreign trusts, Canadian personal property if it is appreciated in value. Departure tax is not applicable to the following properties: real property such as land and building situated in Canada, the property of a business that is maintained through a permanent establishment in Canada, certain property of a returning former resident who last emigrated after October 1st, 1996, property belonging to a short-term resident, that is an individual who is a resident in Canada for less than 60 months in the 120-month period preceding the disposition, when that resident came to Canada, or any property acquired through inheritance after that individual became a resident of Canada. Property that is deemed to be an excluded right or interest of the taxpayer. This includes pension plans, RPPs, IPPs, RRSPs, and RESPs. Life insurance policies. Most Canadians do not pay departure tax because of the various exceptions. Those Canadians who own investments outside of their RSPs or are business owners should be prepared to pay departure tax upon becoming a non-resident of Canada. Security and deferring departure tax. It is possible to defer the departure tax for those who intend to regain residency status, or for those who do not have the funds to pay the tax. This can be accomplished by providing the Canada Revenue Agency with deemed acceptable security, such as bank guarantees, letters of credit, or shares of a corporation which has a value equal to the taxes due. In order to choose this option, you must file Form T1161. Remember that security is only required if the tax owing on the deemed disposition is more than $14,500. Also, if you have already paid the departure tax and intend to return to Canada, then you are eligible for a tax refund. The taxes that are owed on the deemed disposition are due by April 30th or June 15th if you are self-employed. Selling your home after leaving Canada. If you sell your home after leaving Canada, you will have to pay 25% tax on the gross selling price of your home. For example, if you sold your home for $400,000, then you would have to pay a tax of $100,000. A situation like this may lead to financial hardship for many Canadians who are non-residents. Fortunately, there's a special tax election that you can make to reduce the amount of tax to 25% of the gain on the sale of your home. The gain is calculated as the selling price less the original purchase price. You can claim the principal residence exemption for the period of time that you lived in the home. With the principal residence exemption, the increase in the value of your home while you lived in it will not be subject to departure tax. Tip: if you rent your home while you are a non-resident, which many Canadians choose, you will need to file a Section 216 non-resident tax return to report the rental profits made in the year. File a final Canadian personal tax return. You must file a final Canadian tax return, also known as a departure return, for the taxation year during which you leave Canada. On this return, you must disclose your date of departure. Have your personal tax credits reduced by the number of days that you were outside of Canada. List all of the assets that you own if those assets have an aggregate value of $25,000 or more. And finally, pay departure tax on the applicable assets. In conclusion, if you become a non-resident of Canada, you should inform your bank, financial advisor, and pension administrator about the change in your residency status, and disclose all Canadian assets. You are deemed to have disposed of all of your property at its fair market value, and any unrealized gains will be subject to departure tax. If you plan on selling your Canadian residence upon departure, you will have to pay 25% on the gross selling price of your home. Lastly, don't forget to file a final Canadian personal tax return for the taxation year you leave. For more tax tip videos, please click on the subscribe button below and visit our website for additional information. Feel free to follow us on Twitter, Facebook, Instagram, and Google+. Don't forget to like, comment, and subscribe to our YouTube channel. See you soon, and thanks for watching.